This is Daniela Cambone for Kitco News reporting from the world's largest mining convention, the PDAC in Toronto. Joining me now is a presenter here, Dominic Frisby of Frisbys-Bulls-and-Bears. Dominic, so nice for you to be with us again on Kitco News.
It's a pleasure to be here. Thanks very much for talking to me.
So Dominic, give us a little bit of a recap of what you came here to tell attendees.
There was a couple of things. I outlined my long-term targets for gold, which are considerably higher than where we are now. Although I should say at the moment, I think we're in a kind of consolidation mode. If you look at the gold chart since 2001, it had a big run up into 2006, and then it hit a high in May 2006, and it ended a period of consolidation. We didn't see new highs for another 18 months. Then we went to new highs in February 2008, and we had another kind of 18-month period of consolidation, and it went a bit crazy again in September, and we had that high at $1,900 an ounce, and I now think we're in consolidation mode for another year or so. But longer term, I see no reason not to be bullish about gold.
Okay, but much longer term, so you're saying next year at this time, perhaps?
Well, I don't see us going above $2,000 for at least not before next autumn, say. I mean, I'm not selling any of my gold. I'm not bearish on gold,
right.
but I don't see fireworks just at the moment. We're still digesting the previous fireworks. And, you know, gold stocks were horrible. I mean, longer term, by the way, I think we're going to silly numbers. I think, you know, really silly numbers. And I outlined some of those in the presentation I just did. You know, I look at the ratio between US debt and gold and things like that. And if you look at those kind of numbers, you start arriving.
How silly, Dominic?
Well, if the US were to pay off its $16 trillion of national debt with its gold, and it has 261 million ounces of gold at Fort Knox, assuming it's all there, if the US were to use that to pay off its gold, use its gold to pay off its debt, the gold price would have to be $61,000 an ounce. And it did go to that kind of level, equivalent level in 1980. That's why Jim Sinclair sold his gold so famously then. And I think he had a formula. I think he looked at the ratio of debt to the gold price. So it is possible, but remember, it only happened for one day, one afternoon. So if you didn't happen to be at your computer that afternoon, you know, you missed it. And they didn't even have computers in 1980, so it was even harder. But there we go, gone.
So tell me, Dominic, why do you think gold may take this hiatus until October?
I just think we're in a period of consolidation, just a period of digestion. A lot of people, when you get those big sell-offs, there's a lot of leverage players. People spread bet gold, they use options, and people got their fingers burnt. In fact, people who got their fingers burnt last week, we had a big $100 sell-off last week, and, you know, they hurt people, and it takes a long time to restore confidence.
So, Dominic, period of consolidation for gold. What are your thoughts on silver?
The same. With one, the other, more or less. Silver, it seems to have found a bottom at $26. It's tested that low a couple of times. It's found support there. So hopefully 26 is the new 15, or 26 is the new 10. If you see what I mean, it's the new low for gold. And I don't see us breaking above 50 for a while, but we will have a few last nasty corrections like we did last week. But generally creeping up and pretty positive.
All right. So exciting times coming around in the fall, then.
I hope so. Just, can I very quickly talk about the gold stocks?
Sure.
You know, one thing I keep repeating is that just because a company is called gold something or other company, it doesn't necessarily follow what gold does. All that company is doing is raising money and digging in the ground. So the fact that company hasn't gone up when gold has gone up, they're two completely irrelevant things. I have a little technical tool that I use that I outline in my presentation, and at the moment we are on a buy signal for junior resource stocks. And also junior resource stocks are as cheap as they can relative to the gold price. But just because gold is rising doesn't necessarily mean that junior resource stocks will do the same.
Okay, you bring up a good point, because in your presentation you said it's really important to be a skeptic and not to trust no one, really. But how do you choose then? Who should you trust without giving company names?
Well, yeah, a skeptic, a cynic. You don't believe. I mean, companies that are drilling that don't have any cash flow, they have to raise money all the time, and so it's in their interest to get the share price up as much as they can. So they're constantly promoting, and it attracts the worst type of, you know, pump and dump merchants.
Right.
And there's just too much promotion in the sector, but it has to do that. So you just have to not believe everything you hear. You have to find management you like, or read newsletter writers who you trust, or geologists, or talk to as many people. You hear one company's really good, ask anyone you know about that company, get as many contrary opinions, and just be cynical. And then the other thing I would do is look at the overall sector, the CDNX, which is a composite of the Venture and Toronto exchanges, and if the whole sector is trending up, then you be long, and if the sector is trending down, then you don't buy anything until you get a buy signal again.
Good thoughts. So be cynical. Thank you, Dominic.
Thank you. Be cynical, but be positive as well.
And thank you for watching Kitco News. We'll have more coverage from the PDAC. You can email me in the meantime at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.